To start off, just to note, this is my favourite day of the year purely because the London Stock Exchange closes early, so we're all celebrating. But let's run through some of the losers, as you mentioned. We start looking at three stocks in particular: ASOS, Aston Martin and 888. Now, these companies all have one thing in common. They've got way too much debt and investors are worried that it's costing way too much to finance it. They do also have their own individual issues as well. ASOS, people are trading down, looking for cheaper outfits for their Christmas parties and other weekend events, whereas Aston Martin has really been an underperformer over the past few years. It had a cash injection from Saudi Arabia this year, but people think it still might need more, even as they're finally seeing a bit of an uptick in demand. Then we look at 888. Now, this is a betting company that bought rival William Hill. In order to do so, they had to suspend their dividend and also issue some really expensive junk debt.
Right.
Investors didn't like that at all. Then we look at Moonpig.
Yep.
I'll keep going with some of the losers. Moonpig, the final one I'll look at, they've been hit by both strikes and people trading down on their gifting purchases.
I mean, just to set the bar a little bit for our global audience, the FTSE 100 is up 1% so far this year. So if you wanted to beat the benchmark, you'd had to be up by 1%. But what if I wanted to, be the best of all of them? What are the most impressive winners returning?
Yeah, so there's some quite interesting ones out there, Yusuf. And the one that really stands out to me is actually a pawnbroker, which you don't see very often on the market. Now, if the pawnbroker is one of the best performing stocks out there, then it's saying something bad about the economy. People are needing to trade in their valuables for high interest loans in order to fund these rising energy costs. Another one we're looking at is Bay. And I know Bay's been in the news a lot recently, but this isn't Salt Bay. This is the BAE Systems defence supplier. This company obviously has had a boost from the unfortunate war in Ukraine, with companies now pushing up their defence budgets in terms of countries spending more on defence. They also supply the Saudis and the Australian government as well, so it's not just the UK, but that one done very well. A couple of other ones just on the screen here. So we've got Pearson. They formerly owned the Financial Times but have moved into education, and that's been a really booming area since the pandemic with virtual learning. So as you can see, there's a few stocks that have really outperformed there. Very different sectors, from a pawnbroker to an education company, but some big gains of more than 50% for those.
Yeah, I'm looking through some of the rankings and ratings from analysts on some of these stocks, and especially what kind of price growth they're expecting for 2023. Which UK stocks could be the most attractive within that realm for the new year?
Yeah, so I think I'm looking at some of the more domestic names to rebound. So I think the home builder stocks, they've fallen way too much in my view. They're suggesting that prices in the housing market will come down by a massive amount. Obviously, personally, I hope that's true because I'm looking to buy a flat next year. But there are a couple of other more random names. There's a retailer called WH Smith's here, which is exposed to the travel sector. And I think once travel gets back to the pre-pandemic levels, their sales will pick up. They're trading well below 2019 levels. And also Gym Group. People do still want to go to the gym, but Gym Group offers pricing at the very low end of the market. And as we've seen in a lot of sectors going into this recession, it's the low end of the market where people are still going to spend. And I think Gym Group could be a resilient one in London this year.